2 continents, 10 investment metrics, only one winner. A 2-bedroom apartment in Lisbon costs $280,000. In Austin, Texas, a comparable property runs you $385,000. But which one actually makes you more money? European real estate has quietly outperformed U.S. markets in several key metrics over the past decade, yet American investors rarely look across the Atlantic. We analyzed 10 critical investment dimensions, from rental yields to capital appreciation, tax burdens to foreign buyer access, comparing the 2 largest real estate markets on Earth. This is European versus American real estate, and the results may surprise you. Round 10, Market Entry Cost. Let's start with raw numbers. According to Numbeo and Global Property Guide data, the average price per square meter in major European cities is $3,800. In comparable U.S. metros, that figure jumps to $4,600. But the gap widens dramatically at the city level. In Athens, you're paying $2,150 per square meter for a city center apartment. In Warsaw, $3,100. In Lisbon, for $1,200. Compare that to Miami at $6,100, Denver at $5,400, or Austin at $4,900. Even accounting for the larger average American home, the cost of entry into European markets is significantly lower. For a $300,000 budget, you get 79 square meters, that's 850 square feet, in the average U.S. metro, versus 140 square meters, or 1,500 square feet, in Athens. Round 10 goes to Europe. Round 9, Rental Yields. This is where America fights back. According to Global Property Guide, average gross rental yields in major U.S. cities sit at 6.1%, compared to 4.8% for European capitals. Cleveland leads the pack at 11.2%, with Atlanta at 7.8% and Dallas at 6.5%. On the European side, Athens delivers a strong 6.3%, Dublin hits 5.2%, and Warsaw comes in at 5.4%. But here's the catch. European rental markets are far more regulated, meaning lower vacancy rates and more predictable income. Germany's tenant protection laws mean average tenancy lengths exceed 11 years, compared to just 27 months in the US. Still, on raw yield alone, American markets deliver higher numbers. Round 9 goes to the USA, but it's closer than most people think. Round 8, Capital Appreciation over the past 10 years. This is where European markets have been quietly dominant. According to the OECD Housing Price Index, Portugal saw real home prices increase 82% between 2015 and 2025. Greece, recovering from its crisis lows, surged 63%. The Netherlands climbed 71%, and Germany rose 42% before its recent correction. On the American side, the numbers look strong too. Phoenix appreciated 91%, Tampa 78%, and Nashville 65%. But here's the key insight. European appreciation came off much lower bases, meaning investors who entered 10 years ago captured far more value per dollar invested. A $200,000 apartment in Lisbon in 2015 is now worth $364,000. A $200,000 home in Nashville is now $330,000. Europe wins this round by a significant margin. Round 7, Property Taxes and Recurring Costs. This round isn't even close. The average effective property tax rate in the U.S. is 1.1% of the property's assessed value. In states like New Jersey, it hits 2.23%. Texas charges 1.8% with no state income tax offset. Meanwhile, most European countries charge a fraction of that. In Portugal, the IMI tax ranges from 0.3 to 0.45%. Greece charges between 0.1 and 1.15%. Spain averages 0.4 to 1.1%. Even France, one of Europe's higher tax countries, comes in at roughly 0.5 to 1% depending on the commune. On a $400,000 property, An American investor in Texas pays $7,200 per year in property taxes. The same value property in Lisbon costs roughly $1,500. Over a 10-year hold, that's a $57,000 difference eating directly into your returns. Europe wins round 7 decisively. Round 6, foreign buyer access. Both continents allow foreign ownership, but the details differ dramatically. In the United States, there are virtually no restrictions on foreign buyers. Anyone from anywhere can purchase residential or commercial property, no visa required. However, foreign owners face a 15% FIRPTA withholding tax on sale proceeds, and financing is extremely difficult to obtain without a U.S. credit history or social security number. In Europe, it varies by country. Portugal, Spain, Greece, and the Netherlands all welcome foreign buyers with minimal restrictions. Germany allows free purchase, but requires a local bank account. Switzerland severely restricts foreign ownership in most cantons. The major European advantage is golden visa programs. Greece still offers its golden visa for property investments starting at $250,000 in most areas, with a path to EU residency. This round is a tie. America wins on simplicity, but Europe wins on residency benefits. Round 5, mortgage and financing options. If you're planning to use leverage, America has a clear advantage. The U.S. mortgage market is the deepest and most liquid in the world. 30-year fixed-rate mortgages are standard, currently averaging 6.8% for domestic buyers. FHA loans allow down payments as low as 3.5%, and VA loans offer zero down for veterans. European mortgage markets are far more fragmented. Most countries offer variable rate or short fixed-term mortgages. Germany provides 10 to 15-year fixed terms. France offers up to 25 years fixed, but caps borrowing at 35% of income. Interest rates across the Eurozone have dropped faster than in the US, with the ECB rate at 2.75% versus the Fed's 4.5%. But here's the critical factor for foreign investors. Getting a mortgage in Europe as a non-resident is extremely challenging. Most European banks require local tax residency, employment history, and a minimum 30 to 40% down payment. In the US, foreign nationals can obtain mortgages from specialized lenders with 25 to 30% down. Leverage accessibility gives this round to the USA. Round 4, legal protections and market transparency. The Jones Lang LaSalle Global Real Estate Transparency Index ranks the United States as the #1 most transparent real estate market in the world. Title insurance, standardized contracts, MLS databases, and public property records make American real estate remarkably safe for investors. Europe is more fragmented. The UK, Netherlands, and France rank in the top 10 for transparency. But Southern and Eastern European markets tell a different story. Greece ranks 29th, and navigating property purchases requires local lawyers, notaries, and careful due diligence on land registry records that may date back decades. In Portugal, golden visa-related fraud cases have made headlines, and buyers must verify building licenses, tenant rights, and tax clearance certificates. Italy's bureaucratic complexity is legendary, with property transfers sometimes taking 6 to 12 months. For the average investor who values simplicity and legal certainty, America's standardized system is hard to beat. Round 4 goes to the USA. Round 3, currency and inflation risk. This is where the analysis gets nuanced. Investing in European real estate means exposure to the euro, which has fluctuated between $1.03 and $1.12 against the dollar over the past 3 years. That currency risk cuts both ways. It can amplify or erode returns. However, Eurozone inflation has dropped faster than in the US. As of early 2026, Eurozone CPI sits at 2.1%, while US inflation hovers around 2.8%. Lower inflation means less erosion of real returns on rental income. The European Central Bank has been cutting rates aggressively, reaching 2.75% in early 2026, compared to the Fed's 4.5%. That rate differential is driving European property values higher while making mortgages cheaper. For dollar-based investors, the strong dollar actually makes European property purchases cheaper right now, effectively giving you a 5 to 10% discount compared to 2021 prices in dollar terms. The macro tailwinds favor European real estate at this moment. Round 3 goes to Europe. Round 2, lifestyle and residency value. Real estate is the only asset class that doubles as a lifestyle upgrade. And this is where Europe pulls decisively ahead. Buying property in Greece, Portugal, Spain, or Malta can unlock residency permits that grant access to the entire Schengen area, 27 countries with free movement. Greece's golden visa starts at $250,000, rising to $800,000 in Athens and Thessaloniki in 2024. Spain requires a $500,000 investment, but includes a path to citizenship after 10 years. The lifestyle factor compounds the investment. European cities consistently rank higher on quality of life indexes. Vienna, Copenhagen, Amsterdam, and Lisbon all appear in the global top 25. Healthcare in most EU countries is universal and accessible to residents, while the US spends 17.3% of GDP on healthcare with lower outcomes. For retirees and remote workers, a European property isn't just an investment. It's a ticket to walkable cities, world-class public transit, universal healthcare, and 27 countries at your doorstep. This round belongs to Europe. And now round 1, the final and most important metric, overall 5-year projected ROI. We built a model comparing a $300,000 investment in 3 European and 3 American markets, factoring in rental yields, appreciation forecasts, property taxes, maintenance, and currency effects. In the US scenario, a Cleveland rental property generating 11% gross yield with 3% annual appreciation delivers an estimated 5-year total return of 74%. A Dallas property at 6.5% yield and 4% appreciation comes in at 62%. An Atlanta property at 7.8% yield and 3.5% appreciation lands at 68%. In Europe, an Athens apartment at 6.3% yield with 7% appreciation, driven by ongoing recovery, projects a 5-year return of 81%. A Lisbon property at 4.8% yield with 5% appreciation, minus the favorable tax regime, estimates 65%. Warsaw at 5.4% yield and 6% appreciation projects 72%. The verdict? For pure cash flow, American markets win. For total return combining appreciation, tax efficiency, and lifestyle value, European markets have the edge. But here's the real insight. The smartest investors in 2026 aren't choosing one or the other. They're building portfolios across both continents. So here's the final scorecard. Europe wins 5 rounds. Market entry cost, capital appreciation, property taxes, currency tailwinds, and lifestyle value. America wins 3 rounds. Rental yields, mortgage access, and legal transparency. Round 6 was a tie on foreign buyer access, and round 1 showed that overall ROI depends entirely on your investor profile. If you're a cash flow investor who wants high yields, simple legal processes, and easy financing, the United States remains the strongest market on earth. If you're building long-term wealth, seeking tax efficiency, residency benefits, and exposure to recovering European markets, the continent offers compelling value that most American investors completely overlook. The smartest play? Diversify across both. A cash-flowing Cleveland rental paired with an appreciating Athens apartment gives you the best of both worlds. That's our breakdown of European versus American real estate. If you found this analysis valuable, hit subscribe and turn on notifications. We publish data-driven real estate comparisons twice a week, so you can invest smarter wherever you buy. Drop a comment below. Are you Team USA or Team Europe for your next property investment? See you in the next one.